Something big is coming, and most investors are not ready for it. In just days, the United States will release one of the most closely watched economic reports on the planet, the monthly jobs report. And this time, the stakes are higher than they have been in years. Because right now, gold and silver are sitting at levels that could either explode higher or face serious pressure, depending on what that data shows. And here is the uncomfortable truth. Most retail investors will react after the move has already happened. By then, it will be too late. So in the next 12 minutes, I'm going to walk you through exactly what this jobs report means for precious metals, what the smart money is already positioning for, and why the window to act intelligently is narrowing fast. Stay with me, because this is the kind of information that separates people who protect their wealth from people who watch it quietly erode. Let us start with why this particular jobs report matters so much right now. The Federal Reserve has spent the last 18 months telling markets that its decisions are, quote, data dependent. That phrase sounds technical and boring, but it is one of the most powerful statements a central bank can make. It means that every major policy shift, every rate cut, every decision that moves trillions of dollars across global markets depends directly on the numbers coming out of Washington. And the jobs report sits at the very top of that data hierarchy. Here is the critical context. Gold recently pushed through historic resistance levels, crossing territory that analysts previously described as a ceiling. Silver followed, lagging slightly as it always does in early bull phases, but the directional pressure is unmistakable. The question every serious investor should be asking right now is not whether the metals are in a bull cycle. Most serious analysts already believe they are. The real question is whether this jobs report becomes the catalyst that accelerates that cycle, or the excuse institutions use to trigger a short-term shakeout before the next leg higher. Both scenarios are live right now, and you need to understand both of them. Let us look at what the consensus expects from this upcoming report. Economists are forecasting a moderate jobs number, somewhere in the range that suggests the labor market is cooling but is not yet broken. That kind of reading would be what analysts call a Goldilocks outcome. Not too hot, not too cold. But here's what almost nobody is talking about. The Fed does not just look at the headline number. They look at wage growth, labor force participation, full-time versus part-time employment shifts, and revisions to prior months. And in the last several reports, we have seen a pattern that should concern anyone paying close attention. Headline numbers come in strong, creating temporary risk on sentiment. Then, weeks later, those numbers are revised significantly downward. By the time the revision lands, the market is already repriced, and retail investors are sitting in positions built on data that was never accurate to begin with. If that pattern repeats, the initial reaction to this report could be a knee-jerk sell-off in gold and silver as traders price and fewer rate cuts. But the underlying fundamentals would remain completely intact. And that gap between the headline reaction and the real economic picture is exactly where informed investors find their edge. Now pay close attention, because this is where the story gets serious. The Federal Reserve is facing a position that has no clean exit. Inflation has not returned to the 2% target in any meaningful or sustained way. Wage pressures remain embedded in the services sector. Consumer credit is under enormous stress, with delinquency rates rising across auto loans and credit cards. And yet, the moment labor market data shows any real weakness, the political and financial pressure on the Fed to cut rates will become overwhelming. That is the trap. Cut too early, and inflation reignites. Hold too long, and you risk breaking something in the credit markets or triggering a recession that forces emergency easing anyway. Either path, and I want you to hear this clearly, is structurally positive for gold over the medium term. Because what gold prices are not a bet on rate cuts or rate hikes. Gold prices are a bet on the erosion of confidence in the monetary system itself. And that erosion is already well underway. Central banks around the world, particularly in Eastern Europe, Asia, and the Middle East, have been buying gold at a pace not seen since the collapse of Bretton Woods. That is not a coincidence. Those institutions are not buying because they think the jobs report will be weak. They are buying because they understand what a decade of currency debasement, deficit spending, and financial repression does to the long-term purchasing power of paper money. Let us talk about what a strong jobs number would actually mean for the metals. If the report comes in significantly above expectations, say above 250,000 non-farm payrolls with wage growth holding above 4%, markets will immediately reduce the probability of near-term Federal Reserve rate cuts. The dollar would likely strengthen. Treasury yields would tick higher. And in the very short term, gold and silver could face downward pressure, potentially pulling gold back toward key technical support and creating what looks, on the surface, like a concerning chart. But here's the thing. That reaction would be a test, not a reversal. Because the structural drivers beneath the metals have nothing to do with 1 month of employment data. And institutional buyers, the ones who move markets over quarters and years rather than hours and days, would likely view that dip as an opportunity, not a warning sign. This is exactly why smart money is moving early. They know the game. Retail investors see a strong jobs number, assume rate cuts are off the table, and sell their metal exposure. Institutions absorb that selling at more favorable prices and continue building positions that reflect the multi-year thesis. Now let us run the other scenario. What happens if the jobs report comes in weak, below expectations, say under 100,000 new jobs with upward revisions wiped out and wage growth starting to slip? In that case, the narrative shifts almost instantly. Rate cut expectations surge, the dollar softens, bond yields fall, and gold and silver move quickly to price in the new liquidity environment. Silver, in particular, would likely react with significant upside velocity because it carries more leverage to rate cut sentiment than gold, and it is starting from a position of extreme fundamental undervaluation relative to its historical ratio with gold. What happens next could shock most investors who are not positioned before the report lands, because silver is not just a monetary metal in this cycle. It is an industrial metal sitting at the intersection of two of the most powerful demand trends of the decade, the energy transition and the artificial intelligence build-out. Both of these sectors require enormous quantities of silver, and global mine supply has not kept pace with that demand. The COMEX data on silver inventories has been quietly flashing warning signs for months. Physical withdrawals have been elevated. Registered stocks available for delivery have been declining. And the ratio of paper silver contracts to physical silver backing those contracts sits at levels that historically precede sharp price dislocations. That is a technical setup that does not care what the jobs report says. It is a coiled spring. Now, let us place all of this inside the broader European and global context, because for viewers outside the United States, the implications may be even more direct. The European Central Bank is navigating its own impossible position. Eurozone growth has been sluggish, energy costs remain structurally elevated compared to pre-2022 levels, and the political pressure to stimulate is intensifying ahead of several major national elections. The euro has already demonstrated considerable vulnerability against the dollar in recent months. But here is the deeper problem. If the ECB cuts rates aggressively while inflation remains sticky, European savers face exactly the kind of real negative return environment that drives capital into hard assets. Gold priced in euros has already been performing exceptionally well, and that trend has room to continue regardless of what Washington reports about employment. European investors holding significant cash positions in euros or in low-yield government bonds are already experiencing a slow but systematic destruction of purchasing power. The jobs report will move headlines and trigger short-term volatility, but it will not change that equation. Here's the summary that matters. The upcoming U.S. jobs report is a near-term catalyst that will create volatility in precious metals regardless of the outcome. A strong number could trigger a short-term dip that represents a buying opportunity. A weak number could accelerate the next leg higher in both gold and silver. But underneath both of those scenarios sits a structural reality that has been building for years. Central banks are accumulating gold. Physical silver supply is tightening. Currency confidence is being tested across every major economy. And the era of effortless paper wealth through easy monetary policy is coming under serious pressure. The investors who understand that will not be watching the jobs report and reacting. They will already be positioned, watching others react, and quietly holding assets that have stored value for thousands of years. Preparation is not pessimism, it is strategy. And the time to build that strategy is before the data prints, not after the market has already moved. If this analysis gave you clarity or made you think about your own positioning differently, subscribe to this channel and turn on notifications, because the next report we cover could matter just as much as this one. Drop a comment below right now. Tell me whether you are watching gold, watching silver, or watching both. Type gold or silver and let me know where your focus is. Because the next 12 months may define the financial resilience of an entire generation, and the people who prepare early will be the ones still standing when the dust settles.